Have you ever wondered how a tiny little interest rate change in Japan can trigger a massive earthquake in the global economy? It's a strange connection, for sure, but an incredibly powerful one. And today, we're going to dig into exactly why Japan has earned this nickname, the world's ATM.
Okay, so just take a look at this timeline. The pattern here is, well, it's almost uncanny. Back in 2000, Japan raises its rates, and what happens? Boom, the US.com bubble bursts. Fast forward to 2007, they do it again, and hello, global financial crisis. And now, in 2024, another rate hike and right on cue, a major drop in US stocks and bonds. So, is this all just a massive coincidence, or is there some kind of deeper mechanism at play here? Let's dig in.
Well, that mechanism has a name, and it's famously known as the world's ATM. You see, for decades now, Japan has basically been the planet's main source of cheap, almost free money for investors all around the globe. But how in the world did it get that job?
This quote pretty much says it all. For years and years, Japan has had these near zero or even negative interest rates. I mean, just try to imagine a world where if you dared to deposit your money into a bank, you'd actually have to pay them a fee. But on the flip side, if you wanted to borrow money, well, you basically paid no interest at all. This exact setup, this upside-down financial world, is what created a massive, massive opportunity for global finance.
And that opportunity, that whole strategy, is called the carry trade. It's a really simple idea, but it's incredibly powerful. All it is borrowing money where it's cheap, like the Japanese yen, and then investing it where the returns are much higher, like in the US markets. So let's walk through how this actually works. Step 1. A big-time investor borrows a huge amount of Japanese yen at pretty much 0% interest. Step 2. They immediately swap all that yen for US dollars. And then, step 3, they take those dollars and buy something like a US Treasury bond that's paying, say, 4 or 5%. For a really long time, this was seen as a total no-brainer way to make a profit. And the scale of this whole thing, it's just staggering. We're not talking about some small niche financial strategy here. The carry trade is estimated to be worth around $20 trillion. I mean, that's a fifth of the entire planet's GDP, all built on this one simple interest rate difference. And that, right there, is why when this trade starts to unravel, it becomes a very, very big deal for all of us.
But okay, this is where the story takes a really strange turn. I mean, standard economics, the stuff they teach you in Econ 101, says that when a country raises interest rates, its currency is supposed to get stronger. But with Japan, the exact opposite has been happening.
So here's the paradox in a nutshell. What's supposed to happen is this. Japan raises rates that should attract foreign money and the yen gets stronger. Simple, right? But the reality is, Japan raises rates and money actually seems to flow out, making the yen even weaker. This completely defies conventional logic, which tells us there has to be another factor at play here. And that other factor is something called imported inflation. The theory here is that Japan's inflation isn't happening because its own people are spending too much money. Nope. It's because the country has to import most of its food and energy. So when the yen gets weaker against the dollar, the cost of just bringing those essential goods into the country, it just skyrockets. And this chart really lays out the evidence. If you look at the last decade, the two biggest spikes in Japanese inflation happened at the exact same time that yen's value took a nosedive against the US dollar. This strongly suggests that the real solution for Japan's inflation problem isn't higher interest rates, it's a stronger currency.
So if raising rates isn't the real answer, then what is? Well, this brings us to the real clue. And what this analysis argues is Japan's most powerful economic weapon, its massive stash of US government debt.
You see, Japan is the biggest foreign owner of US treasuries, and that gives it a really powerful lever. The logic is super simple. If Japan wants to strengthen the yen, all it has to do is sell its US bonds and use the money to buy back its own currency. To weaken the yen, they just do the opposite and buy more US bonds. But here's the puzzle. Right now, they're actually buying US treasuries, which weakens the yen, while at the same time raising their own interest rates, which hurts their own businesses. It makes absolutely no sense. It's completely contradictory.
And this leads us to the big critical question. Why would Japan follow a policy that seems to be actively hurting its own economy and not even fixing its core problem? Well, the analysis we're looking at here proposes a very controversial and frankly startling theory.
The theory is called the harvest, and it basically argues that what looks like a series of really bad policy mistakes isn't a mistake at all. Instead, it's a deliberate, multi-stage plan to actually engineer a crisis to get a very specific result. This theory has three distinct steps: the feeding, the detonation, and finally, the harvest. So let's break down each one.
All right, first up is step 1, the feeding. So for decades, Japan plays the part of the world's ATM, right? It's handing out cheap yen for that carry trade. But, according to this theory, while all the global investors were busy playing with financial paper assets, Japan was quietly using its influence to buy up real, tangible, productive assets all over the world. We're talking iron mines in Australia, huge farms in Brazil, factories all across Asia.
Then comes step 2, the detonation. The US Fed starts raising interest rates, which puts the squeeze on that whole carry trade. And right at this precise moment, the theory claims Japan hits a kind of self-destruct button. It raises its own rates, but just enough to hurt its own companies, while doing nothing to strengthen the yen. In fact, it just makes their imported inflation problem even worse. And this brings us to the final, and frankly, chilling step, the harvest. All that self-inflicted economic pain forces Japan to sell its massive holdings of US Treasury bonds just to raise cash. But remember, US rates are high now, so the value of those bonds has totally collapsed. This means Japan is forced to sell at a huge loss, which creates a massive wealth transfer to the US. Then, with Japan's economy in a full-blown crisis, the theory alleges that Wall Street investors can just swoop in and buy up all those amazing global assets Japan collected, the mines, the farms, for pennies on the dollar.
Now, look, it's really important to remember this is just one theory from one analysis. It's a pretty wild one for sure, but it does force us to ask a really provocative question. When we see these major economic policies that just don't seem to make any sense on the surface, could they be part of a much larger, longer game? Is it possible that the world's next financial crisis isn't just some random event, but something that's actually being engineered? Definitely something to think about.